Let's take a closer look now at the trade tensions and relations between China and the United States, the world's top two largest economies. China imports capital-intensive goods and high-tech products from the United States. It exports labor-intensive products. So do the structural differences between these two countries hurt or benefit the United States? Who really benefits from this relationship? Here's CGTN's Lily Liu with more.
Official data showed that China directly invested over $16.9 billion in 2016, becoming the fifth biggest investor in America. The amount of capital and the large range of investments brought rapid growth to the U.S. information technology services and manufacturing sectors. Naturally, the recent trade tensions between the two nations have aroused great concern.
They're a huge concern. They're a huge concern because we've been working really hard for over 10 years in growing our market and growing our consumer base in China. And this will have an impact on us and our importers and our partnerships.
Wine traders like Honig in California's Napa Valley complain about the trade conflicts. That's partly because American employment relies on Chinese investment to a certain extent. Chinese companies hired 91,000 local employees in the U.S. in 2016, tripling the employment number from 2013. For China, American high-tech products give consumers a chance to enjoy a high-quality lifestyle. American companies also boost development in China and advance Chinese technology.
Right, then let's dig a little deeper into this particular story. Stephen Roach is a senior fellow at Yale University's Jackson Institute of Global Affairs. He's also a senior lecturer at its School of Management. Before that, though, among other things, he was Morgan Stanley's chief economist. He joins us now live. Thank you for your time this evening, Professor. Is the market reaction to the tariffs and the threat of escalation, is that reaction overdone?
I don't think that's the case. You know, both the United States and China are heavily committed over the last 25 to 30 years to building a strong economic relationship, and one that involves many other partners around the world through supply chain connections. And you know, the markets are certainly we're priced in a very optimistic position at the end of last year, hoping that this relationship would continue to underpin the trend in global trade. And so to the extent that, you know, doubts get thrown on that key assumption, there's a good deal of consternation and understandable volatility. The fact that the signals are mixed and that, you know, one day they seem to get worse, the next day they seem to get better, sometimes several times in the same day, if anything, compounds the volatility and adds to the confusion. But the bottom line is that these markets, certainly equity markets in the United States, are priced for an ongoing continuation of the relationship between the United States and China, and if that gets thrown into serious question, then the markets will correct very sharply.
Indeed. Assuming that China's counter tariffs come into force, how many American jobs really are at stake here? Brookings had an analysis a little earlier today pointing to over 2 million jobs in 40 industries as being vulnerable. Do you agree?
I think it's hard to be quite as precise as that study, which I've looked at carefully. It's a very sort of well-designed effort to map employment in China-centric export industries on a state-by-state basis. I think 2 million is a reasonable ballpark for total disruption of the export flows over a long period of time in the items that China has announced that they will retaliate on. But that would take many years to unfold. The real risk, I think, is if there is continued escalation in one move after another, and that could really do a damaging blow to